All right, let's talk about IPOs. Today, we're going to crack the code on them. My goal is to completely change how you look at initial public offerings. We're going to shift from seeing them as a lottery ticket to seeing them as a structured opportunity that you can actually build a strategy for. Let's dive in.
Let's be real. Does this question hit close to home? You apply for an odd IPO, you cross your fingers, and nothing? It can feel totally random, super frustrating. But what if that feeling just comes from playing the IPO game with the wrong set of rules?
Because here's the thing, even while the wider market has been a bit shaky, some IPOs have been quietly delivering huge returns. We're talking 30%, 50%, sometimes over 100% gains. The opportunity is definitely there, but you need a totally different approach to get a piece of it.
And this is probably the part that feels all too familiar, right? That feeling of never getting an allotment for the good ones. Or maybe you apply to literally every IPO that has some buzz around it. Or you finally get one, and then you sell way too early. Or you panic and sell too late. And the worst? Getting stuck holding an absolute dud. If any of that rings the bell, don't worry. You're in the right place, because we're going to fix that.
Okay, so the very first step is to completely change your mindset. Stop thinking of IPOs as just one big event. Start seeing them for what they are, a game. A game with different levels and different types of players. And your success depends entirely on knowing which type of player you are. So here's the breakdown of who's on the field. First up, you've got the retail investors. That's most of us, right? Applying with up to 2 lakh rupees. For us, it's a pure lottery system. Then you have the H&Is, the high net worth individuals. They're split into small and big categories. Small H&Is are also in a lottery, but their odds are a little better. Now, the big H&Is, that's where the rules completely change. For them, it's not about luck, it's proportional. Think about it. If that part of the IPO is oversubscribed 10 times and they apply for 1 crore, they're pretty much guaranteed to get 10 lakhs worth of shares. The more they put in, the more they get. And that's why for us in retail, it's all a game of probability. So since it's a probability game for us, your job is simple. You only play when the odds are overwhelmingly stacked in your favor. And how do you do that? With a really solid professional-grade filter. This checklist is going to be the foundation for every IPO decision you make from now on. This is it, your 5-step checklist to run before you even think about hitting apply. Number 1, is the business actually good? Is it scalable? Number 2, what do the financials look like? You've got to check for growing revenue, profit, and, this is super important, cash flow. Number 3, is the valuation insane or is it reasonably priced compared to its competitors? You can find all this stuff in the company's main document, the DRHP. 4, why are they raising the money in the first place? And finally, number 5, are the big guys interested? I'm talking about the qualified institutional buyers, or QIBs, the huge mutual funds and financial institutions. If they're in, that's a massive vote of confidence. Getting a strong yes on these 5 points, that's how you boost your odds.
Let's just zoom in on number 4 for a second, because this one's a big deal. The purpose of the issue. A fresh issue is what you love to see. It means the cash they raise is going right back into the company to grow the business, pay off debt, you name it. An offer for sale, or OFS, on the other hand, that means the money is going into the pockets of existing owners who are selling their shares. Now, it's not an automatic deal breaker, but if it's a pure OFS, it could be a warning sign that they think the best days are behind them.
So just to make it crystal clear, here are the IPOs you should almost always just skip. A company doing a pure OFS, especially when the market's at a peak, red flag. A business with weak or negative cash flows, big red flag. An IPO that's all hype and story with no solid numbers to back it up, avoid it. And finally, if you read about the company and you just can't figure out how they make money, just walk away. It's not worth it. Okay, so let's fast forward. You used the filter, the IPO checked all the boxes, you applied, and you got the allotment. Awesome. But hold on, the game is not over. In fact, some of the most important strategic decisions happen right now.
All right, scenario 1, the dream scenario. The stock lists with huge gains. We're talking 20, 30, 40%, or even more. The temptation here is to get greedy and hold on for dear life. But discipline is everything. The truly smart move? Book some partial profits. Get your original investment back out, plus a little extra, and then you can let the rest ride if you still believe in the company long term.
Now, what if the listing is just meh? It opens right around the price you paid. The absolute worst thing you can do here is panic sell. Instead, this is where you become a detective. You need to watch the trading. Are a ton of people selling, or are buyers starting to step in? Your decision here has to be based on data, not fear.
And finally,
The one nobody wants. A weak listing. The stock opens way below what you paid. Listen, there is only one rule here, and it is non-negotiable. You cut your losses. Fast. Your number one job as an investor is to protect your money. You take the small loss and you move on to the next opportunity.
And here's a thought that really separates the pros from the amateurs. That listing day pop is exciting for sure, but the real money, the sustainable, long-term wealth, is often made in the weeks and months after all that initial hype has completely faded away.
So to really master this whole IPO game, we have got to bust some of the most common and costly myths out there. Let's just tackle them head on.
Oh yeah, this is the big one. Almost every retail investor is obsessed with the gray market premium, the GMP. It's that unofficial price people are willing to pay for shares before they even list. And a lot of people think it's basically a crystal ball that predicts exactly what will happen on listing day.
But here's the reality. The GMP is just a signal of demand. It's an indicator of hype. It is not a guarantee of anything. It can be wrong, and it often is. It's a useful data point to look at, sure, but it should never, ever replace your own analysis. Your success comes from following a disciplined process, not from a rumor in an unofficial market.
And here's the other myth. And this one comes from all that frustration of not getting allotments. It's so easy to start feeling like the whole system is just designed for you to lose. But the reality is, for a retail investor, it is a probability game. You're not going to win every single time. But by using that strict filter we talked about, and only applying to the highest quality companies, you can dramatically shift the odds in your favor over the long haul. You aren't destined to lose. You're just playing a slightly different game than the big institutions. So let's end on this note, because this is the single most important thing I want you to take away today. Stop treating IPOs like they're lottery tickets. Start seeing them for what they really are, structured opportunities. It's a game of probability for retail, a game of capital for HNIs, and for everyone after listing, it becomes a game of skill. If you can master these ideas, you'll have a seriously powerful tool in your investing toolkit. So the real question is, are you ready to play the game differently?